Joining me right now, independent advisor, Alliance Chief Investment Officer, Chris Zaccarelli. Chris, great to see you. Thanks very much for being here. What do you make of this market performance and the focus on the geopolitical tension surrounding Pelosi's trip? How do you see this market?
Well, market's been rallying since July. Really, we ended the end of June with markets priced a little bit below 16 times earnings. We finished the end of July more like 17.5. So the rally can continue. I mean, clearly we saw the sell-off yesterday. People were worried about what would happen if there was any tensions between China and Taiwan over Nancy Pelosi's trip. Now that she's leaving, there's a little bit of a relief rally, but we think the rally can continue. There's a lot of headwinds, obviously, with inflation, with the Fed raising interest rates. There's problems ahead. There's got to be some turbulence and some volatility for certain, but at least for now, the rally can continue.
Okay, but Chris, what about the macro story? We know that we're in a recession. At a minimum, we're slowing down considerably. I spoke with the chairman and CEO of Bank of America yesterday, Brian Moynihan, my special guest. He talked about the strength of the consumer, but you have to wonder when the 40-year high inflation cuts into jobs. Here's what Brian said about the Federal Reserve's impact. Watch.
The Fed's toughest job is that the consumer is relatively strong, that the work of the last administration, this administration, to give consumers money to spackle over, to take care of the issues caused by the pandemic is still in the accounts, and that's going to make the Fed's job tougher as we look forward. But right now, the consumer continues to have money in accounts, continues to spend, and also has the ability to borrow on their lines of credit and things like that, and that's good news. Unfortunately, that makes the Fed's job very tough.
Chris, what about that? We had 75 basis points, 2 meetings in a row. We've got the next Fed meeting in September. Chicago Federal Reserve President Evans yesterday said he's anticipating only a half a point hike after the 75 basis points. A lot of Fed speak yesterday indicating the Fed is not going to stop until we see a real move in inflation lower. How does that impact investing?
So that's really where the uncertainty lies. To the extent that the consumer is very strong, they're going to continue spending. It's possible that unemployment stays low and that we could be in this period for an extended period of time. And that's how the market can continue to rally. But absolutely, if interest rates have to keep going higher, if inflation eventually cuts into what consumers are able to do, we could have some layoffs. And once you start that layoff cycle and unemployment starts to climb, then we can have a recession that gets even deeper than what we're seeing right now. We absolutely have a technical recession, 2 quarters of negative GDP growth. The question is whether or not we continue at this pace and we just muddle along with nominal GDP almost as high as inflation starting to come back down, or a worse scenario where obviously nominal GDP growth slows considerably and inflation doesn't come back down. That's really the main question. And this situation can persist for months. And I think a lot of people were pricing it in a much deeper downturn earlier this year, and now they're not so sure. I think markets are really trying to find their way at this point.
Yeah, James Freeman, let's talk jobs. U.S. job openings pulled back in the month of June. Just 10.7 million job openings. That was down from 11.3 million in May. We're still talking about millions of jobs. Yeah. We're looking ahead to the July jobs report this Friday. But we have layoffs. We've got hiring freezes, James, layoff announcements in tech. And does that continue as the recession deepens?
Yeah, the trend is not good. You see the JOLTS report there. That is still a historically very high number of job openings, still a lot more jobs than people looking for jobs in terms of unemployed. But obviously the trend not good. And so, Chris, I'm wondering, what is your base case? What are you investing on? Is it that muddle along scenario you were talking about, or is it the something worse you were talking about?
We're obviously, cautiously optimistic. We hope things will muddle along, but we are a little bit more concerned about what can go wrong. And so for that reason, we've been tilting our portfolios a little bit more towards the defensive side of things. We've been looking at healthcare companies, which are much better to own, more resilient earnings during recession. And we are concerned about inflation risks. We think the inflation risk is not off the table. So to the extent that you could own some energy companies, gas pipelines, oil pipelines, something to that extent, we think adding a little bit of protection in your portfolio while still staying fully invested is the best course of action, because we are a little bit concerned that worst case scenario will eventually come to pass. I think it's anyone's guess when that will happen. It may not happen until next year or even to 2024, although things, to your point, are headed in the wrong direction. And I think that's what concerns most people.